Stop looking for a parking spot. Stop arguing with the barista about oat milk versus almond milk. Because in about 6 months, you'll be grateful if you can afford the cup. Pull the car over. Turn off the radio. And listen carefully. You are hearing the sound of history breaking the sound barrier. Ladies and gentlemen, Asian guy here. It's Wednesday, January 28, 2026. And if you thought the last 48 hours were crazy, you haven't seen anything yet. Today, we witnessed a market event that should not happen. Financially speaking, this is the equivalent of a total solar eclipse happening at the exact same moment as a volcanic eruption. Here's why that matters. In normal markets, there's a seesaw. When people feel confident, they buy stocks. When people feel afraid, they buy gold and silver. Risk on. Risk off. That's how the system works. That's how the algorithms are programmed. But today, the seesaw didn't tilt. It snapped in half. Everything is up. Not up a little. Vertical. Let's look at the scoreboard, because if I hadn't seen this myself, I'd assume the data feed was hacked. The S&P 500 just smashed through 7,000. Not tested. Not paused. Blew straight through it. At the exact same time, gold hit an all-time high of $5,300. And silver, the metal they told you was dead at $90, just broke $115. Meanwhile, the president is celebrating. America is back. Stock's huge. Greatest economy ever. And if you're a casual observer, maybe you believe it. You glance at your 401k. You see big green numbers. You think, I'm rich. Maybe I should buy a boat. Do not buy the boat. Do not buy the hype. Because when stocks and gold explode together, it does not mean the economy is strong. It means the denominator is dying. This is called a crack-a-boom, a term coined by economist Ludwig von Mises. It's the final phase of a currency's life cycle, when people realize money itself is losing value. So they panic buy everything. Stocks, real estate, art, gold. Not because they want these assets. Because they're terrified of holding cash. Apple didn't suddenly sell millions more iPhones overnight. Nothing fundamentally changed. What changed is the dollar. It now takes 7,000 weaker dollars to buy what once cost 5,000 stronger ones. That's not profit. That's inflation. If Venezuela's stock market rises 1,000,000%, are investors geniuses? No. They're starving, because bread rose 1,000,000% too. That is what we're watching unfold in real time. And gold is the lie detector. If the economy were truly strong, gold would be crashing. You don't buy insurance when your house is fireproof. You buy it when you smell smoke. And at $5,300 an ounce, gold is screaming one thing. This isn't prosperity. It's panic. The financial house is fully engulfed in flames. And let's talk about Trump's tweet again. America is back. There's a brutal irony here. Trump has demanded a weaker dollar for years. He wants exports booming. He wants manufacturing back onshore. To do that, you need a cheap currency. You need American goods to be cheap for foreigners. Well, the market gave him exactly that. The dollar is being crushed into oblivion. But here's the side effect no one wants to talk about. When the dollar collapses, the price of everything you import goes vertical. Oil, electronics, coffee, silver. So while Wall Street celebrates growth, the working class eats the bill. This is not a victory party. This is a funeral for purchasing power. And the most dangerous part of this inflation tsunami is not the price. It's availability. Because while the screens are flashing green and politicians are taking victory laps, the physical plumbing of the market is seizing up. You see $115 silver and think, okay, that's expensive, but at least I can buy it. Can you? Are you sure? Because the reports coming out of the supply chain say the price is now theoretical. We need to talk about China. We need to talk about the Shanghai blackout. And we need to talk about what happens when factories go 15 days without seeing a single bar of silver. The lights are flickering in the east. And that darkness is moving west. Not a power outage. A supply chain cardiac arrest. Look at the news coming out of Shenzhen this morning. Shenzhen isn't just a city. It's the factory of the world. The silicon heart of Chinese electronics. And inside Shenzhen is Hubei. This is the jewelry and precious metals capital of China. If gold and silver are moving in Asia, they move through Hubei. Normally, it's chaos. Armored trucks in. Bullion vans out. Refiners shouting orders. But today? Silence. A local industry report dropped a headline that should terrify every industrial buyer on the planet. Half a month without receiving any silver. Let that sink in. 15 days. Zero inventory. The biggest manufacturers in China placed orders. They wired the cash. They screamed at brokers. And Shanghai didn't deliver. The trucks are empty. That $20 arbitrage premium we talked about? It worked too well. It didn't just drain the West. It drained the floating supply of the entire world. And it still wasn't enough. This is the nightmare scenario. Silver isn't a shiny rock for a safe. It's an industrial necessity. No silver, no solar panels. No silver, no electric vehicles. No silver, no precision weapons. So when Shenzhen hasn't seen a bar of silver in 2 weeks, it means assembly lines are about to stop. And when assembly lines stop, panic begins. We are no longer in a price crisis. We are entering an availability crisis. A factory owner in Beijing doesn't care if silver is $115 or $200. If he doesn't get metal, his factory shuts down. Workers go home. Contracts default. He will pay anything. And that's why the price is now unanchored. There is no resistance level when the metal itself disappears. The alternative is bankruptcy. Now think about the ripple effect of the Shanghai blackout. If China is dry, where do they go next? They move down the chain. Korea, Japan, Switzerland. But those vaults are already being drained. So now Chinese industrial giants are bypassing the exchanges entirely. They're sending agents straight to the mines in Mexico and Peru. Not with contracts. With cash. Or more accurately, digital yuan. They are trying to buy the ore before it even comes out of the ground. This is a resource war. The breakdown in Hubei is the signal. The official market is broken. Metal is no longer flowing through visible channels, because those channels are empty. So while Wall Street throws a ticker tape parade and algorithms celebrate the S&P 500 at 7,000, the real economy is seizing up. The atoms are missing. And in a normal shortage, you'd expect dealers to be bidding aggressively. You'd expect them to be screaming, "I will buy your silver." But that's not what's happening. Here's the twist. While prices scream higher and China runs out of metal, U.S. dealers are acting strange. They aren't buying. Some of them are refusing to bid at all. We're seeing a retail liquidity freeze that completely contradicts the price chart. Why would a dealer refuse to buy silver at $100? Because they're broke. Not insolvent in metal. In cash. This is the liquidity trap. And this is why you might try to sell your stack and find no buyer. The window is closing, but not the way you think. It's closing because the market makers have run out of the one thing required to make a market. Cash. In a normal bull market, liquidity is everywhere. Money flows. You buy. You sell. The gears turn. But in a hyperinflationary melt-up, the gears strip. The price is moving faster than the dealer's cash flow can keep up. We've seen this before. 1980. But this time it's digital, instant, and far more dangerous. The no bid sign is going up. Now listen carefully. If you're holding large bars, especially 1,000-ounce industrial bars or even kilo bars, you're probably looking at $115 spot and doing the math. 1,000 ounces. That's $115,000. I'm rich. Then you pick up the phone. You call your local dealer. You call the big online wholesalers. You say, I want to sell. And instead of excitement, you hear silence. A pause. A sigh. Then the sentence that stops your heart. We're not buying large bars right now. Or worse. Spot is 115, but I can only offer 90. This is happening. We have confirmed reports from industry veterans and wholesale desks seeing bids come in 20% below screen price. Is the price fake? No. The silver is real. The problem is liquidity. Dealers spent the last 3 weeks chasing price, buying inventory as silver ripped from 70 to 100, selling to a panicked public. They drained their cash to stay stocked. Now the price is higher. Demand is higher. And they have no dry powder left. They can't bid, even if they want to. And that's when markets stop behaving like markets. That's when price discovery breaks. They emptied their bank accounts to stock up on eagles and maples. They are long metal and short cash. Now the price spikes to 115. You walk in with a monster box you bought 5 years ago at $20 an ounce. You're asking the dealer to cut a check for $50,000. He can't. Not because the silver isn't real. Because the cash isn't there. His vault is full of metal. His operating account is empty. He can't liquidate inventory fast enough. And he can't hedge the risk. COMEX margins just jumped to $51,000. He can't short paper to lock in a price. So he's frozen. And when a dealer is frozen, he does the only thing he can do to survive. He lowballs you. He offers 90. Not because silver is worth 90, but because that's the only way he can turn metal into cash. If you accept 90, he flips it to a refiner or desperate industrial buyer for 110. That spread keeps the lights on. That difference is a liquidity premium. You're paying a fee for cash. This is the liquidity trap. It creates a split market. On the screen, silver is 115. On the street, the bid might be 90. The ask might be 130. A $40 spread. This is what a dying currency looks like. Trading friction explodes. Market seize. You own the asset, but you can't convert it. You're rich on paper. Trapped in the physical. And this is where psychology turns dangerous. You see a $90 bid and panic. You think the price is fake. You think it's collapsing. And you sell. Do not do it. Do not hand over generational wealth at a discount to fix a dealer's cash flow problem. This freeze is temporary. It's the shock of repricing. Eventually, the real buyers step in. The industrial giants. The Teslas. The defense contractors. They don't care about broke dealers. They bypass them. They pay the full price. But during this transition, the street price is broken. Now here's the twist. There is one signal that cuts through all of this noise. One indicator with a perfect historical record. And it just fired. We need to talk about Jim Cramer. Because if there's one man who never misses the top, it's Jim Cramer. This morning, right as silver broke resistance, he tweeted, "This silver move is getting ridiculous. Parabolic moves always end in tears. I'm cashing in the family silver. Bears win here. Sell, sell, sell. Print it. Frame it. Kiss it goodnight." Because Jim Cramer is not an analyst. He's a counterindicator. A cooler. The angel of death for any trade he touches. Remember 2008? 1 week before Bear Stearns collapsed, a viewer asked him if Bear was safe. He said yes. You know what happened next. So if you were worried about $90 bids and broken markets, relax. The inverse Cramer has arrived. And historically, that only ends one way. He screamed, "No, no, no. Bear Stearns is fine. Do not pull your money out." 5 days later, the stock went to zero. Do you remember Silicon Valley Bank? He called it a strong buy right before it imploded and triggered a banking panic. Do you remember Meta? He recommended it near the top, then cried on national television when it bottomed. The man has a supernatural talent for being wrong at the exact moment it matters most. So when Jim Cramer looks at silver at $115 and says, "Sell," what is he really telling us? He's telling us the top is not in. He's telling us we're nowhere near it. If Cramer thinks silver is a bubble at 115, the real bubble probably doesn't even start until 200 or 300. That tweet was the all-clear signal. Hedge funds that literally run inverse Cramer strategies flip their switches. And yes, those strategies are real. They buy because he sells. This is the psychological fuel the market needed. Markets climb a wall of worry. They crash on euphoria. If everyone was screaming, "Silver to 1,000," I'd be worried. But the most famous voice on Wall Street is mocking the rally. That tells you retail hasn't gone all in yet. The public is still selling too early, which means massive amounts of capital are still sitting on the sidelines, waiting to panic buy higher. Cramer didn't stop the rally. He guaranteed the FOMO phase is still ahead. He poured gasoline on the fire he was trying to put out. So don't get angry. Don't tweet at him. Thank him. He's shaking out weak hands so strong hands can accumulate. Despite the liquidity freeze and dealer lowballs, prices going higher. Because the universe has a sense of humor. And it loves humiliating Jim Cramer. While he's selling his family's silver to a dealer who probably won't even pay him spot, the real money is doing the opposite. They're draining the vaults. We just got the updated delivery numbers from COMEX. And if you thought the Shanghai blackout was bad, wait until you see New York. The paper market is bleeding out. The bullion banks are losing control. We need to talk about the 48 million ounces that just walked out the door. Let's go to part 5. Let's talk about the drain. While Jim Cramer stands in line in a pawn shop, the entities that actually run the world are backing up dump trucks to the loading docks of the New York Commodity Exchange. Forklifts are working overtime. Stop watching the clown on TV and look at the ledger. Because the ledger tells the story of a bank run accelerating faster than our most aggressive models. We just received the January delivery totals. And remember, January is supposed to be quiet. Historically, it's a non-delivery month. Vault managers play solitaire. Traders go skiing. This January? It's a crime scene. Total deliveries have surged to 9,680 contracts. Do the math. Each contract is 5,000 ounces. That's 48.4 million ounces of silver. Nearly 1,500 metric tons. In a month that usually sees 3 to 5 million ounces, we just saw 10 times normal volume. And it's still accelerating. Just this morning, on a random Tuesday, another 79 delivery notices were issued. This is not normal. This is a run. And when metal leaves the vault this fast, there is only one possible ending. Was the bank desperately trying to stop the bleeding? Wells Fargo. The data shows the Wells Fargo house account stepped in and took delivery of 52 contracts. That means the bank itself is being forced to eat the metal. Either their clients are demanding physical, or they are racing to cover internal shorts before the audits begin. When a bank like Wells Fargo is scrambling for physical silver in a non-delivery month, panic is no longer retail. It's institutional. And this creates a mathematical impossibility for COMEX. If 48 million ounces drained in January, and the pace continues through February, then by March, the primary delivery month, the vaults are done. Empty. And I need to be precise here. Effective empty doesn't mean 0 ounces. It means the only metal left is owned by people who will not sell at any price. Eligible metal. The registered category, the metal actually for sale, is being vaporized. This is the final stand. The banks are throwing everything they have at price suppression. But they are losing the physical war. And the smart money knows it. The whales, the people who have survived 50 years of cycles, see the writing on the wall. Once the metal is gone, exposure shifts. You don't buy bars. You buy the ground. We are watching the rotation into miners. And the biggest signal just came in. Eric Sprott, the man who practically built the modern precious metals bull market, filings show he just bought another 100,000 shares of Hycroft Mining. Why buy miners when silver is already at all-time highs? Because the next phase isn't about what you can hold. It's about what hasn't been dug up yet. When the vault runs dry, the mine becomes the vault. Mining stocks are the call option on a COMEX failure. If silver is forced to 200 by physical scarcity, miners don't double. They go tenfold. This is positioning for the resource control phase, where owning the source matters more than owning currency. And look where the capital is coming from. It's not just cash. It's rotation. While gold hits 5,300, crypto priced in gold is collapsing. The ratio is breaking down. The digital gold narrative is cracking. Because when systems fail, metaphorically or literally, you can't barter with the token. You need atoms. Crypto whales are selling coins to buy bars. And when they can't find bars because of dealer freezes, they buy miners. So let's take stock. Vaults are draining at record speed. Banks are panicking. Whales are buying the mines. Retail is selling early, guided by Jim Cramer. This is a perfect storm. This is a bipolar market. And bipolar markets destroy the unprepared. But they reward patience. Now let's finish this. Here's the verdict. We are living in two realities. On the screen, everything looks fine. Stocks at 7,000. Gold at 5,300. Silver at 115. Green arrows everywhere. That is the paper world. But in the physical world, liquidity is gone. Supply chains are freezing. Dealers have no cash. Vaults are emptying. This is not a bull market. This is a repricing of reality. So what does that mean for you? It means don't confuse price with liquidity. Don't panic sell into broken markets. And don't believe comfort narratives during structural failure. This is not about timing the top. This is about surviving the transition. Because when this resolves, it won't resolve gently. And when the dust settles, there will be two types of people. Those who held real assets. And those who held promises.